A lot of folks we run into think they're diversified because they might own 10 different stocks. But they may own 10 stocks in the same industry. So if you own 10 tech stocks, you're diversified amongst the technology sector, but you're not diversified amongst the equity markets. And so we want to help them to understand that. We want to get exposure in different areas, because when technology stocks may not be doing well, maybe energy stocks are doing well. Maybe financials are doing well. And so we want to balance that out. And that's what mutual funds and ETFs allow us to do. Has anyone ever heard FANG, the FANG stocks? FANG stocks. So the FANG stocks, a lot of folks bought the FANG stocks. I'll tell you what they are in a second. And they said, I'm diversified. I got the FANG stocks. And so basically it's Facebook, Amazon, all right, Netflix, and then Google had to go and throw us off. It used to be Google, now it's Alphabet. So I guess it's the FANA stocks. But those were the FANG stocks. And so people were buying those. And yes, they've made a lot of money, but they've also taken on a lot of risk. And the problem with owning stocks individually is it's great when they're going up, but how do I know when to sell it? You know, nobody's going to tell me when to sell it. You don't get online and say, hey, the top 10 stocks to sell now, right? It's only the top 10 stocks to buy now. And so we want to make sure that we're helping to educate the investing public on ways to diversify that risk. And so we use mutual funds and ETFs often to access the market. So is anyone familiar with, people familiar with mutual funds, ETFs? Okay, we got a few folks. So a mutual fund is a fund where many different investors pool their money together to buy a basket of securities that fund is trading, called the portfolio. So you get a portfolio of stocks. In this case, we'll use stock mutual funds. You get a portfolio of stocks. It could be 20 stocks, 30 stocks, 150 stocks. But let's say we all got together in this room and everybody threw $25 into a pot. And then I took that money and I left and I said, see you later. No, I took that money and I own a mutual fund. I created a mutual fund at my company and I take all that money, and now that money is worth quite a bit. I can now go buy a bunch of different stocks with your $25. Whereas with $25, you may have only been able to buy one. And so this gives you access for a much smaller investment to a broader spectrum of stocks and or bonds if you're buying a bond mutual fund. Okay? So a mutual fund is designed for really smaller investors to get access to a diversified portfolio. Now, there's somebody that's actually in an actively traded mutual fund. There's somebody that is actually trading that on your behalf called the portfolio manager. And so if I were to go to Charles Schwab and buy one of Charles Schwab's actively managed portfolios, and I say actively because I'm going to talk about what a passive mutual fund is in a second, but an active mutual fund, there's actually going to be somebody on the other end of it, could be one individual or a team of individuals, that are making the decisions on my behalf what stocks to buy for my money. Now, every fund has an investment objective that you guys will get to understand before you put your money into it to make sure that is the right objective for you and that money is invested towards that specific goal you want that fund to invest in. And so because of that, there's a lot of different mutual funds. There's thousands out there. And the first mutual funds started in the early 1900s, and they've grown into a very robust industry. And so they're buying and selling stocks each and every day out there for individual investors. And so when you're investing in a mutual fund, you're actually paying somebody to do this for you. Okay, so there's no commissions for all the trades that are taking place. There's no commissions. So let's say you put in $500 into this mutual fund. Then they're going to charge you a percentage of your $500 to invest it for you. Okay? An actively traded mutual fund, let's say it's usually around 1% for ease of conversation here. Okay? So you got to pay somebody to do that for you. Now, you're hoping they're making the right decisions. Okay? And so you're able to see what they buy. You could typically see, the top 25 holdings in that portfolio and see what you own. But now you are an owner of that basket of stocks. And so that's one way to diversify. There's different types of mutual funds. So there's growth mutual funds, which are going to buy like FANG stocks. They're going to have Apple, Facebook, Netflix, Amazon. Then there's going to be value mutual funds. So they're going to have General Electric in there, maybe a Chevron, ExxonMobil, more of those value type companies. And then amongst the growth and value, you're going to have small cap, mid cap, and large cap. So every mutual fund is going to have its own investment objective. So you may have a growth mutual fund that invests in large cap stocks, and maybe that's what you want. And so you can go and invest in that mutual fund and get access to those different types of securities.